Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, 11th of August, and rising oil prices are again fueling inflation worries around the world and pushing global yields higher ahead of tomorrow's closely watched US CPI report. So the US dollar remains under pressure these days as questions around the Federal Reserve's independence under the new Fed chair brings the South America trade back to the table as gold benefits grandly from this intense geopolitical, fiscal, and monetary uncertainty. And well, with the Fed's guidance increasingly opaque, investors will have to do the heavy lifting in the coming months and quarters. So we will talk about all that, the complex global macroeconomic situation and the impacts on cross-market prices. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So risk appetite is weakening globally along with rising oil prices that fuel global inflation expectations and push yields higher. US crude today is consolidating near the $82 per barrel level after a more than 6% surge on Monday's trading session on the back of little progress in US-Iran peace negotiations. Trump reportedly made new demands from Iran, quite crazy demands, including compensation for people killed and damages in a war it did not start. So it doesn't sound promising to me for an immediate peace deal. As such, risks remain tilted both ways, price-wise, as investors continue to react strongly to Donald Trump's peace hopes. But concretely speaking, Washington's peace promises have been unfounded since the beginning of this war, and there is no guarantee whatsoever that the current diplomacy will lead to any kind of lasting peace in Iran. As such, spot prices in oil are rising faster today than the futures prices, hinting that investors are back to trading the worries of tighter short-term oil supply due to a prolonged closure of the Strait of Hormuz when the traffic across the Red Sea is also being threatened by Houthi attacks. On the other hand, a credible reopening of the Strait of Hormuz or a peace deal and or further promises from Washington that investors would believe could knock a lot of premium out of the front end very quickly. This is why the short-term risks are tilted both ways. In the longer run, I expect oil prices to come back to pre-war levels when the war ends, obviously. But today, uncertainty in the Middle East, the rebound in oil prices leading to a rebound in global yields again is waiting on global indices near their record high levels still. So the situation is not alarming, but US and European indices look like they are going to take a breather before tomorrow's US CPI data, as yesterday's was not necessarily great. Look, Nvidia's fresh $500 billion funding package from Wall Street heavyweights reignited worries about the circular deals in AI, somehow outweighing also the 45% sales surge that TSMC announced yesterday. Remember, on that matter, Nvidia has recently pledged to guarantee financing for $250 billion worth of AI data center for OpenAI, which is one of its biggest customers. Now, we don't know yet if yesterday's $500 billion funding announcement is part of that deal, but the fact that Nvidia is securing fresh funding and huge funding to invest in its own clients so that they could continue to buy these expensive AI chips from them means that the AI money is still turning round and round among a handful of AI bodies, with the risk of a domino effect taking place if something goes wrong in one of these companies is in the line. This is exactly why Nvidia saw its price plunge 2.86% yesterday on the news, and broadly speaking, a broader benchmark for chip makers fell more than 2% in the US yesterday, but the memory chip maker heavy Kospi index is up again this morning on news that Samsung considers a massive shareholder return package, but the dip buyers may remain timid despite the news following a sharp correction that took place between June and July in the Kospi index, hurting a lot of retail investors that thought that this rally would never end. So broadly speaking, for the Korean memory chip makers, past year's chip mania could well be over. I'm sorry. even though the Korean chip makers will continue to benefit from the massive AI build-out, and that's two Korean chip giants, Samsung and SK Hynix. These companies today have forward PE ratios falling to around 5 times. So the prices are great, but chip valuations don't guarantee the immediate return of speculative long positions, which made these traditionally boring stocks the hottest commodities for months into the latest sell-off. So I think that on the contrary, a further downside correction is more likely to be on the menu today. A fair to be followed. Now, moving on the macroeconomic picture, the Reserve Bank of Australia maintained its rates unchanged today as widely expected, pointing at rising unemployment in Australia and weakening property prices. So the Aussie dollar reacted to the news by easing below its 100-day moving average, while the US dollar index is consolidating its recent weakness near its own 100-day moving average right now. Into the US CPI data released tomorrow, the rebound in oil prices and yields are clearly supportive for a stronger US dollar in the shorter run, while the waning confidence in Fed's real intention to bring inflation down toward the 2% policy target is bringing the sell the America trade back to the table, and that is actually clouding the long-term outlook for the US dollar, making it weaker actually. And that's especially visible in gold's rise along with oil and US yields. These days, the price of an ounce shot above the $4,400 per ounce level yesterday. Now we are well below the $5,600 mark reached at January peak, but the longer-term fundamentals remain supportive for the yellow metal because we have these geopolitical uncertainties, trade uncertainties, US uncertainties, exploding DM debt levels, and weakened appetite for US dollar and US treasuries all together due to all these happenings around the US. Note also that the inability to contain the yen's weakness against the US dollar is also a risk for US treasury yields. That's the reason why US is so involved in trying to stop the yen's depreciation past the 160 level, because Japan is one of the world's largest US treasury holders. The weakening yen could eventually force the Japanese institutions to sell their treasury holdings to compensate for the weakening yen, and the latter could, in theory, apply additional pressure on the US yields, something that the US doesn't want to happen, especially not now. As such, the dollar yen's approaching the 160 level again following a short-lived intervention relief last week is not necessarily good news either for global macroeconomic picture in the short run. So today, the cautious market feeling will likely remain in play as investors will likely remain on the sidelines before tomorrow's most closely monitored US CPI data. Now, it's a sure thing that last Friday's soft US jobs report softened the hawkish Fed bets, but there is now this growing worry for global macro investors today. The one that points at the possibility that the new Fed chair, Kevin Warsh, will indeed become a sock puppet to the White House, and that his first weeks in office was just a temporary show of independence from the big boss in the White House. Because as we move forward, we see that Warsh is seemingly on its way to make the Federal Reserve an obscure room where economic, monetary policies will be mixed and matched with the White House's own political and geopolitical ambitions. And that's a piece of news that also largely explains the returning appetite for gold in the expense of the US dollar and US treasuries these days. But the thing is, even though Warsh becomes more elusive regarding the Federal Reserve's reaction function in the face of rising inflation in the US, I believe he's still smart enough to know that losing the Fed's credibility and the market's support would make his monetary policy decisions less effective, actually to the extent of making them totally meaningless. That's why US data matters more as the Fed gets opaque, as the market will have to do the heavy lifting in the absence of clear Federal Reserve guidance. The reasoning is always the same. Stronger than expected inflation would push the yields higher and weigh on risk appetite, while benign inflation numbers from the US could soften the hawkish Federal Reserve bets without, however, fully taming them as oil prices continue to surge and threaten inflation. And it's important to note that at the end of the day, the markets, so we all together, not the Fed, will be deciding where the borrowing cost should be. Those wondering what happens when the Fed or other central banks resist adjusting policy rates in line with economic fundamentals like inflation and unemployment to please the politicians in White Houses around the world who simply want lower interest rates because politically this is what's best for them, we must have a look at Japan and Turkey to understand how poorly managed monetary policies can pressure currencies in the longer run and ultimately sicken economies. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.